Well, welcome back, my friends, to the final video in our fundamentals of investing. And we're trying to put it together here. We're going to look at mutual funds and exchange traded funds, or ETFs. We've talked about stocks, individual stocks, which run all over the place. Hundreds of thousands of companies you could invest in. Talked about bonds, talked about real estate, the different aspects of that type of investing. And again, we've even talked about collecting gold, silver, paintings, all sorts of interesting ideas. Is there something there? Is there something out there? Is there that it's a vehicle that we can combine a little bit of everything that we've learned so far? And this is the vehicles, or these are the vehicles, the mutual funds and ETFs. So, again, read this chapter in your book. I'm going to give you the broad sketches for you to do lots of research with, and this is how you can really grow your investments, my friends. Mutual funds are investments that pool your money together with investors to purchase shares of a collection of stocks, bonds, real estate, securities, whatever the fund wants to invest in as a portfolio. Now, Warren Buffett could do this. Bill Gates, Jeff Bezos, we could go down the 1,000 billionaires that exist in the United States. They could probably do it, but most of us who are working hard and trying to, survive and fight the dragons in life, most of us just don't have that type of equity and capital to do that. This is why a mutual fund can do it. Now, they're basically overseen by a professional portfolio manager. Now, I'm going to have to take a quick aside here. Friends, my background has been in entrepreneurship. I've owned my own business. I've managed small business. I've been in sales. And so I tend to get real excited over things. And so just remember that. I'm a marketing background, so I may be trying to sell this pretty hard. I'm not trying to. I just get excited about it for you. There's nothing that I would benefit from selling you. It's just education. And that's what I most like to get excited about, is to teach somebody something new, and if they can improve their lives on it, that's great. So you'll see the background of my enthusiasm. Now, mutual funds, most households, again, have this because you can invest this. These are the investment, and then we can utilize the vehicle. The vehicle would be a 401k plan. The vehicle would be your traditional IRA or your Roth IRA. Okay, the vehicle could be just your investment and you just want to buy mutual funds, but they can be used in a variety of different ways, and ETFs. So it's very easy to invest. They are professionally managed. Okay, that still means you do your research, but you don't have to research every single thing. They're very diversified. We were looking for that. We were looking for, wow, can I get a little bit of everything? So if one part goes down, would everything else go down? So you have that diversification. Friends, if every company and every industry went bankrupt, then we would literally be in the apocalypse. Okay, the earth would just be blowing up. That's what would have to happen for every single thing to be worth nothing. Now, if I just invested in one company and it could take a dive. Okay, it could go bankrupt. It could be bad management. The CEOs and the board of directors were stealing from it. Lots of different things could happen if we're just in one type of a stock or investment or asset. Again, you're in hundreds of different organizations, possibly 1,000 different investments in a mutual fund. So you're really diversifying yourself, which spreads the risk over hundreds of stock in different industries versus just one. So look at it. We're going to kind of unpack this, the characteristics of mutual funds. There are some closed-ended funds, which means the organization, the fund, was established. It purchased its company. They gave so many shares out, and now when those shares are sold, the only way you can get in that is to purchase a share from another person. You can't just go out and to Fidelity. Okay, we'll talk about Fidelity, Vanguard, TIA, Craft, any investment opportunity or investment organization, and say, hey, I'd like to buy some of this mutual fund. They may say, well, we're sorry, it's closed. I can find if someone is going to sell it, and of course you'll pay a premium for that. So that's what a closed fund is. I just can't automatically get into it. I've got to wait till somebody else sells their shares. And again, Why would someone close it? They have the investment they need, and this is they're not actively seeking more investment in that fund. This is very professionally managed. Okay. There's the open fund. 9,000 investment companies offer open funds. Okay, which means we're happy to take your money. We'll always sell you shares and grow your investments. And so, again, you buy and sell the shares basically on what's called the net asset value. So, and I'm going to show you that on a mutual fund web research here in a few minutes. Net asset value is the fund's portfolio minus their liabilities, almost like the accounting equation. So what's the net worth? And then how many shares are outstanding, and you get the idea of what you would pay per share. So New American Frontiers, 655 million, has 5 million liabilities, so and 30 million outstanding shares. When we do that math, we get $21.67 per share is what you would pay for that per share for that mutual fund. And again, generally you put in amounts that we'll look at. For like an IRA, you put in 2,000 to 2,500, and if you don't have that much, you can start doing an account building, which is basically $100 a month debited from your account to start building up those shares. Types of mutual funds. Again, there are lots of different things out here, and this is some of the information you need to know as you get into this. There's loads, just everything we've talked about, from stocks, from bonds, from real estate, from buying the art to selling your art. Everyone has to make some money. And so this is where your broker, this is where the investment professional makes their money. No load funds charge no fee to buy or sell shares, but they're going to get their money somewhere. Okay, they get it through their management fees. Loaded funds charge investors a commission up to 8%. And again, decades ago, if you were selling mutual funds, you made a very, very good living because there weren't so many around, and basically you always got an 8% commission. And when someone puts in 100 grand, well, you can do the math real quickly there. That's not bad at all to get an $8,000 commission. So they're could be front-ended or back-ended, which means when you purchase the fund, that's when the commission is taken, or when you sell your shares. Again, you can sell a variety of shares. You don't have to sell every one, and to get some of your money out, and that's when the fund is hit. But of course, there's always management fees, and so every year your investment is somewhere between 0.5, half a percent to 2% of the fund's assets, or, and again, that's the same in your account. That goes to management fees, and there's the expense ratio to having everything that they have to do, and that's generally around 1% or less. So, and we're going to look at some of the fees, why you would pay more or why you should pay less on that. But again, they're going to get their money, but that's not that. I would not worry about that. I would strategize about how do I start getting into this and start investing. So, as we look at classifications of mutual funds themselves, they are in varieties of sectors. Most are in stocks, okay? And so if you're starting out and you say, I want an aggressive growth fund. So what an aggressive growth fund does is they buy stocks in very fast growing companies. They could be biotech, they could be just technology, they could be anything that's a small company that, again, the investor believes has got a good valuation and is going to grow fast. Okay, aggressive growth should give you higher returns than other funds. It also has higher risk. Equity income funds invest in stocks with a long history of paying dividends. So again, maybe when we're changing investment strategies, and the great thing about this, again, as we look at the investment and then we look at more vehicles and wrapping up our financial plan, which is unit 4, or again, our next set of lectures, that, you know, I'm older and I want to preserve my income, so I don't need the growth. I have $500,000 over 40, 50 years of investing in my IRA or in my 401k, and so now I want to reallocate my funds to something different, which is the great thing. You can do this throughout your investment type. Global stock funds are going to buy global stocks in companies throughout the world. Again, we've got growth, index, international, large cap funds. Again, these are giant funds that only invest in companies that are capitalized at least 8 billion to 20 billion or more, so they're very mature. So again, things that you or I probably could not do on our own, we can say, well, I'll put some of my percentages of my funds in growth and index. What about oil? I wish I could get into oil. There's sector funds that go just in natural resources. As you start researching, you can pretty much find a fund. There's just real estate funds. I want to get into real estate. And again, when you have several funds going into your investment, then you've really diversified yourself. You've got diversity among diversity. Other types of funds, there's the regional funds, there's the sector funds. Some of us are saying, you know what, I want to invest, but I don't want to invest in companies that I don't believe are socially responsible in the world, that they're doing things that I don't agree with. Well, then you've got that. You've got that's probably one of the faster growing sectors right now are socially responsible funds, and so that don't produce harmful products, that that are very socially, that won the social responsibility award. So again, you can find what I believe is the fund of your choice to start your investing with. Okay. Now, there's also a bond fund. Again, as you are in different areas and you're thinking that, wow, again, the one thing about mutual funds is they are terrible short-term investments. Again, we're not looking at short-term. I've never tried to prescribe that as a, able to really turn capital around quickly within a matter of days or weeks. These really have to go for years. This is your long-term strategy here because they can fluctuate. So if you see that the economy is turning in a different way, you want to be able to start reallocating funds, and you can put your money from high growth into a bond fund. And generally speaking, the investment company that you're using will have these. So we're looking at muni funds, we're looking at short-term, looking at long-term bonds to give you more of an interest rate. Again, we're just trying to preserve and protect, because that's always an investment strategy. Other bonds, yes, again, the junk bonds, the intermediate, the corporate, they're out there. There are more investment opportunities for you in the mutual funds. And again, if it gets so confusing and you say, gosh, all of this, and it is, it can be very overwhelming. You have funds in organization that say, hey, here's an asset allocation. We're going to basically have it spread out through the entire investment stratagem, so to speak, the whole horizon. And we've got large cap, we've got international for you, we've got bonds, we've got alternatives, we may even have some energy stocks. You don't have to worry about anything. And of course the balance fund as well, that will basically primarily objectives. There's also age-based funds as well that people are using obviously for their retirement. Again, the company that you work for more than likely is going to have a 401k or a 403b option for you for your retirement, which we will talk about. Heads up advice, you start funding that as hard as you can, and you always fund those to the maximum that the company will match. Okay, don't let the company keep money from you, because most people are letting that happen, which means they're not making their match. So you put that in there, and then you can put in any type of, and then you get to choose the funds. Okay, and we'll show that again in our wrapping up our financial plan. Funds of funds. Yeah, again, you can invest in mutual funds that invest in other mutual funds. Probably a little lower rate of return, not too much, but again, you really have diversity. There's your lifestyle right in there, which means it takes your age. So if you are in your beautiful 20s or beautiful 30s and beautiful 40s and outrageous 50s and 60s, it just even gets better, my friends. But if you're in those younger stages, you're going to go much more aggressive investments. And then the closer you get to retirement, the fund rebalances itself and goes into more like money markets and bonds. And again, it's all about preserving the hard work you've done. I think you get the picture, of why I believe mutual funds are high quality investments, and they can really help you get that 10 to 12% rate of return, that you don't have to do a tremendous amount of anxiety. You just let that invest, and you check it and you research it, and let it do its job, and you don't panic. Again, when the pandemic hit and it's running its course for the next few years, a lot of people saw investments go down, and mutual funds can go down pretty quickly as well. And so they said, okay, I'm going to get out. That is never the time to get out of the market. You've got to do your research and work in basically almost a year in advance to when you say, hey, things are going great, but I see the horizon and the future doesn't look great. I'm looking, because I've taken other business courses, and I'm looking at the general economy, and so I'm going to start moving my funds into safer funds, because you can, and then you can move them right back in. But during a panic of any type, my best advice, hey, and I've done it wrong several times, and so learn from my mistakes. Don't panic. Leave it in there, even if you think it's going down, down, down. Because again, the market went down to 6,000 points from 16,000 in 2007, 8, and 9, and look what it did. It came right back and almost hit 30,000. So if it goes down, buy more. Yeah, absolutely. Just you're buying it on sale. That's what I like to think about. So the family of funds here, my friends. Each one, again, when you get into a company, and I'm going to pick Fidelity because they're based here in Westlake, and they have tremendous amounts of funds. And again, maybe your organization will use Fidelity as an option. Again, it could be Vanguard, it could be TIA, CREF, it could be anything. I just happen to know the Fidelity website pretty well. I don't have investments there, so I'm not making, you know what, there's no conflict of interest here. But they have tremendous amounts of funds that you can manage your investments with. So again, you can move into different funds. You can basically transfer from one fund to another once you have enough money and you've been there a while. Now, exchange traded funds. I love these too. All right, here we go. Exchange traded funds are basically an algorithm that is set up on an index. Again, the New York Stock Exchange those are index funds, which means they follow companies on that, or the NASDAQ, or the American Stock Exchange. They may not actually be managed by portfolio. They literally may be managed by bots. Okay, they're artificial intelligence, and they're based on different type of algorithms that see the market change, and they get into investments a little bit quicker. It's a little more time. They're a little more timely, in my opinion, than a mutual fund. And again, you can have both. Okay, there's only about 1,900. I think you're going to see more of these exchange traded funds, but they mirror indexes, so they're a little faster and responsive to what the stock market is doing. On the mutual fund, you have the portfolio manager who has to see the results and say, okay, let's move into different stocks. And this is basically done, again, through indexing. So it's a little more responsive. And I love this, okay? I do have an account here, and a student told me about it. And I was a little sketchy at first until I did my research. And I think this is a great vehicle for students because they give you a free account. Yeah, and even if you're not a student, like myself, the fees are very low. It is basically done by artificial intelligence. The people who started it is based off a Nobel Prize winner in economics on his investment strategy. So that is the algorithm that runs the fund, and it takes your change, your spare change. That's why it's so great for a student, because the expenses are so low, and the ways that you invest is basically it links into your bank account. You can always add money to your accounts, but it link into your bank account and then invest your spare change. So if you spent $21.50 and you want to round up to $1, it would round up that 50 cents, and that 50 cents would go into your investment account at Acorns. So I'm going to show you this, and I'm also going to show you how to research mutual funds. So I'm going to go online, and we're going to look at a couple of these things. And again, how do we build a habit? We build that habit. We make things easy. We make them small, no stumbling blocks, and we make it automatic. And that is the best way to start your investing. So let's take a look at Acorns and Fidelity's mutual fund research. So here is the Acorns site, and again, this is where you would just get started, my friends. Acorns is a exchange traded fund, as I've mentioned. It is great if you're just getting into the investing arena, and it's easy. What it does is it's a free account for students, so use your TCC, your My TCC email, and as you see, you'll do everything on your phone, which is why so many people like it. You can get an invest account, and you can also get a later account. Now, the later account is your IRAs, and you can choose between a Roth and a traditional IRA. Friends, you are going to choose the Roth IRA, as we have spoken about, as I will speak about in our unit of finishing your financial plan. The Roth IRA is tax-free. That's why you want it. And here's what it does. In the invest account, you get to invest your spare change. You can also utilize this as a checking account as well. So if you're in the unbanked area right now, you don't have a lot of banking, you can utilize this as your debit and your checking account, or you simply link your checking and your savings account to your app. Again, to this company, which is Google it up again. Look at the reputation of Acorns. It's legit. It's the real deal. But you get to get that spare change, which means, again, if you've bought something at Chipotle for $7.65, the 35 cents is rounded up and deposited into your account. So it's micro investing. But think of all the stuff that you buy a week, and we all say, "Man, I wish I could invest a little bit." They'll let you do that. Most major investment firms want thousands of dollars to you for your investments, and we understand why. And then there's your later account as well, and it gives you all sorts of knowledge. They email their newsletters to you, and again, $1 to $3 a month. But if you're a student, they knock it down to pretty much no charge at all. Again, I learned this from a student. I do have an account. I've been able to save more money than I ever have in my investing, just because you can always add a quick $25, $100, basically once your accounts are linked up. If you shop at different areas like eBay, Nike, Walmart, and they've got a lot of organizations basically partner in with them, they will give you, once you click that, so if I click the Walmart button right there, I go on to walmart.com, buy $100 worth of stuff, you get 1% back. So that's $1, but that dollar goes right back into your invest account. You do that throughout the years, you basically, I'm on track for at least a $100 or $200 this year, just because of normal spending that I would do in different areas. So that's great. There's, again, how ways to invest, what's the portfolio, what am I investing in? So everything is very straightforward. Again, they use a mix of stocks and bonds and money markets, and it bases it on your age. So that's really cool. There's your later account. Again, to get started there, you can choose your IRA. Again, traditional or Roth. Please pick the Roth. There's your spending account. That's if you want to have a checking account right there with your card that always adds up early. This is for your children. So if you're out there with, you have children and you want to start them on an account, you get some accounts for kids right in there. They'll open it up. And again, this whole process, my friends, to start it, I think it took me 10 minutes. That's it. Earn, grow, and pricing. So that is Acorns. Again, it's an exchange traded fund. It's a way that you can start looking at investing via your phone. There's really not a minimum, and you can put in weekly deposits. You're rounding up your money. It's a really fun way too to start getting into the investment world, and do it for very low cost. And for people who never thought they could start without thousands of dollars, you don't have to do that. So there is Acorns. I recommend it. I have no problem recommending it, just because I've seen what they do. They're very very, very compatible with students just to the pricing fee. I learned it from a student, and I highly recommend an easy way. Just this is just one of your methods, one of your channels, one part of your toolbox to start investing. What we'll also look at, so that's that. We also want to look at Fidelity. Now, again, I just chose Fidelity because it's got a very easy website. So I'm not saying this is the only one. Vanguard, TIA Crefel is a very good one. There's other sites, but Fidelity is a huge mutual fund research. They're a huge investment company. They're right here in the Dallas-Fort Worth area in Westlake. And again, your 401ks or your IRAs may be funded, or basically Fidelity could be the fiduciary responsibility, which means they manage it. So let's look at some mutual fund research as well. What I did, I went just right in here and said my key criteria. Right now, if I was to look at everything that Fidelity can offer you, there's 3,461 funds. Well, I think I'll just pick Fidelity funds and see. Okay, 316 right now. Okay. Uh, I could go by asset class. I could go all assets. I could go money markets, bonds, all the things that we talked about. Let's just pick all assets up there. I can look at by risk. I can go very low risk. I can go very high risk. Yeah, let's just take that off and say, see if it'll go right into the middle. All right, we'll leave it more of the high risk right now. Funds. What about ratings? Now, Morningstar is a rating company that just basically rates the bond, the composition of the fund. It also looks at the management team. So let's just say a nice high one. Returns, well, let's crank it high. We want high returns. Expenses, we're not going to worry about. Again, it brings me down to 7 funds. Now it brings me down to 19 funds for above average. Again, have fun with this. Put in different numbers, and let's see what we got. And when we do that, I'm going to hit my next tab up here. I got this many funds. And here's how to read that. This is the life of the fund, the 10, the 5, the 3-year fund, the results. 1 year, this fund, and I just picked it right off the top, Fidelity Blue Chip Growth. It has had an average return of 60%, 58.29%. From the year to date, it's done 42%. All right, rule of 72. My gosh, is this money doubling every year? Is this too good to be true? Well, over the life of its fund, and we'll look at this one. When was it in the inception? It's gone basically 13%. Okay, well that's great. Again, we just want to rule up that 72, and at 13%, that money is doubling every 5.5 years. That doesn't mean every year is 12%, but it's done very well the last 10 years. And that's nice. We want to see, is the fund, does this fund reach back into the 80s or the 90s where it's basically had to go through a lot of different business cycles? Well, it was at least 10 years, and it's done almost 20%. Okay, there's your expense ratio. It's under 1%. Under 1% is good. There's the Morningstar overall. Let's look at it in depth, and when we click this, we just go to the summary of the fund. Okay, so high rates, high returns, average expenses. I'm willing to pay a little higher expense for certainly something that's had this type of growth. So that makes sense. Here is what we would call the top 10 holdings. Well, what is this fund invested in? 46%, almost half of the entire fund is, we have Amazon, Apple, Microsoft, Google, Facebook, Tesla. So we can see quite a bit, and this is electronic processing and manufacturing, quite a bit of high-tech sales and high-tech companies. I wish I could have all of these stocks in my portfolio. Well, there you go. You got it. And again, between Alphabet and Amazon stocks, those are over $1,000 a share, just to begin with. So it looks like it has $41 billion worth of assets. Okay. And then there's the 12-month high to low per share. that we would have to purchase this app. Let's keep looking through here, my friends. It will also try to average out. These are other bigger funds in different sectors that are close to this one. So it gives you a comparison. I mean, are they doing that great? Well, there's the Russell 1000. That's always a very large fund that gets compared against too. And so it's right on average, actually well above average this last year. And those companies have done so well. Again, all the different things. And this is where you would just really dig down deep and want to do all your research. Here's the fund manager. You can do all other sorts of great stuff there. When I pulled back in, this is the looking at more of the fund. So we've got 40% of information technology, consumer discretionary, communication services. Then it goes into healthcare and industries, kind of basically diversifies the rest of the fund. But you can see this is a tech-driven fund, and these are only invested in what we would say the biggest blue chips. So again, you'll find more information. Are you able to? It is a no transaction fee. So, in summary, as you look at your mutual fund research, again, this was the Fidelity Blue Chip Growth Fund. If you hypothetically had $10,000 in the year 2010, in 2020 you would have right about $60,000. Again, these are their strategies, message from the chairman. So you can, what I'm trying to say here is you can do a tremendous amount of research right in here and get your funds, your mutual funds, set up. Now this was a primarily tech fund. If you wanted to, I've just went in and found a retailing portfolio. Again, it's going to have just a little bit different setup. And so you look at Amazon is still there, but Lowe's, Home Depot, Dollar General, the Dollar General stores, type of stores, everything a dollar, et cetera, have been some of the highest growth in retailing for the past 10 to 12 years. There's Dollar Tree. There we go. So this just kind of this very value generated retailing has done a lot, and because certainly of different spending patterns. So those top 10 holdings right there represent 70%. Again, if I were to look at this, the yield for this year is almost 30%. Last year was 30%, 30.2. Last 10 years, 19.67. And again, you can always go back and look at the inception dates as well. Let me get that summary back here. Sometimes I get too crazy and start hitting everything. This was in 1985. Okay. A fund since 1985. Boy, that was a great year, my friends. That was a great year. I was a baby, but it was still a great year. So now we are, what, 30 to 40, let's just say 30 years past that. This fund has seen a lot of traction. It's weathered a lot of storms, and it's been basically running at about 15% annual rates for the last 30 to 40 years. So that ought to give us some confidence. I'm looking at the minimums to invest, and right now you'll have to call. But if you wanted to buy, you see that button, you buy right there, you make your accounts up. And I do not have anything with Fidelity. Okay, just want to, no conflicts of interest here. I don't own any stock of it. I just wish somebody would have told me this many years ago. But you can do some great research, so I hope this helps. There's the Fidelity. There is that Acorns account. So between the two, wherever you are, if you're just starting out and you know you don't have the type of funds that you wish you could, but you could put maybe $5 to $10 in a week, well, then this is a great way to do that right here. Most other investment companies just can't look at that. That's not their business model, but this one is in rounding your roundups up. So in a couple of years, you could have some great traction. If you are experienced, if you're really trying to, what we would say, get into the investment world and get that IRA maxed out every year, get all your investments maxing and with a lot of diversity, then the Fidelity, the Vanguard, the TIA craft, the whatever program that you like would be another way to go, and you can mix and match them. So I hope that helps as you start gaining more research. If you can't do it right now, at least look at the research, look at how to do it, and then when you're ready to invest, you'll be way ahead of the game. All right, we're going to finish up this unit with the next slide. So again, as we finish up this PowerPoint, as this lecture on mutual funds, as we finish up some of our investing, you can start your growth in this manner. Let's say you want to invest in several of these funds. Great. You can put into your IRA or your 401k. You can basically put in a percentage to your large growth, your growth in income, aggressive, international, if you wanted natural resources, if you wanted bond markets. As you start gaining more capital inside of your mutual funds, or specifically those retirement vehicles, you're able to now put different percentages of your retirement income, which we'll talk about, in those funds. So now you can average that 12% on the long term and really diversify your money. Friends, we just went over some hopefully some very good tips. Let's recap. There's Mr. Buffett again. I don't look to jump over 7-foot bars. I look around for a 1-foot bar that I can step over. What he's saying is, I like to do things that are simple, that have the proof behind it, that are known, known constants in the investment world. So don't jump over the step. I know it's very enticing what we just looked at, but hey, if I'm still sitting with a lot of debt, personal debt, I don't have that emergency fund built up where it needs to be, and I'm just getting my budget underway, we've got to get those steps done first. Okay, build that emergency fund up to, again, 6 months of my expenses. Have my debts paid down to where they're very manageable. Maybe it's just the house. Certainly credit card debt has paid off, and hopefully if it's school debt, it's much better under control. I think you'll like that so much more. Again, why I'm saying that, if we jump into investing and we push everything in there and it's looking good and an emergency comes along, I've seen it so many times. We're seeing it right now in this global pandemic, and I don't fault anyone for it. But we tend to basically go get our investments, cash those, so we can pay for some of those emergencies. So build that up, get ready. Now we think about investing, and of course, you can always do research along the way before we get there. We keep it simple. I do think high quality mutual funds and exchange traded funds are going to be a great avenue for you. You do need those 5 years in any investment. If you're just trying to get something for the next 2 or 3 years, then just save like crazy, okay? Squirrel away all that money. And then, of course, we want to make it a habit. We want to make it automatic. We want to make it simple. And with electronic transfers and account builders, once you get these accounts up, you'll just have those directly deposited into those funds. And I should have one more bullet here. Don't panic. When things go crazy and you're still in the market, so to speak, don't jump out. We needed to have made that decision a year in advance. And it's okay if you didn't. We ride it through, because it will always come back. It always has. If it doesn't, then hey, it's a zombie apocalypse. So we don't have to worry about that either, right? Right. Hope you enjoyed it. The next part of this course will be putting everything together, okay? Completing up our financial plan. Let's always make it a great day.